Stubborn inflation, supply chain disruptions, and the trade wars. These are the grim prospects the world faces under Donald Trump's alarming executive orders. The chaos that followed after February 1st demonstrated how unprepared the markets were for this scenario. Most market participants believed that the tariffs would be introduced gradually. The announced lofty 25% tariffs were viewed as just another threat from the eccentric US president. His aggressive rhetoric was largely met with skepticism. Donald Trump himself contributed to this self-deception. His speeches always balanced threats with the talks of negotiations, but as it turned out, the White House was not looking for any negotiations at all. On the 13th day of his presidency, Donald Trump slapped both neighboring countries with the 25% tariffs. China joined Mexico and Canada on the list, though it was only hit with a 10% tariff. As for the next target, the Eurozone, it will not be spared earlier. According to Trump, the White House will definitely impose tariffs on European imports. However, no details regarding their rates or implementation timeline have been disclosed yet. Canada has already announced countermeasures against the US imports, effective from February 4. Meanwhile, China has opted for a different approach by filing a complaint with the World Trade Organization. At the same time, Washington has not ruled out discussions with the Canadian Prime Minister and Mexican leadership. After all, a small loophole remains. The law does not take effect until February 4. Trump has expressed confidence that American consumers will understand the supply chain disruptions caused by the tariffs. In reality, while his voters may tolerate accusational empty shelves, they will not be happy about price hikes due to tariffs, so inflation acceleration is inevitable. From now on, all imported goods from the targeted countries will become 10%, 25%, or even more expensive. Besides, the main burden of the Trump-induced inflation will fall squarely on the shoulders of the consumers. As the trade conflicts expand geographically, the US dollar is likely to strengthen steadily, primarily as a safe haven asset. While the turmoil has sent competing currencies tumbling, the US dollar index surged by 1.2% against its six major counterparts, approaching 110 points. The euro-dollar pair recorded its steepest decline since November, dropping by 1.1%. As a result, the euro firmly settled in a bearish territory, opening the first week of February with a downward consolidation in the range of 1.0210 to 1.0270. Meanwhile, the descending channel is moving toward the technical support level of 1.0177. A breakout below this level would pave the way for the euro to reach parity with the US dollar, or even fall to 0.9730, its lowest level since November 2022. Notably, this downtrend has been in place for a week following the US tariff debacle with Colombia. Monday's cautions trading reflects the market's anticipation of further updates from the United States. Should any positive signals emerge in this context, the euro may experience a temporary bullish correction. In this scenario, the nearest resistance levels would be the level of 1.0369 and the psychologically significant round level of 1.0500. As for oil prices, the tariff chaos has worked in their favor. Brent crude, for instance, kicked off the new week with nearly a 1% jump following Friday's close, trading higher in the range of $75.90 to $77.50 per barrel. Although the tariffs on the Canadian energy exports have been set at only 10%, they affect the entire energy sector, oil, gas, and electricity, given that Canada is the primary oil supplier to the United States. These commodities are expected to rise in price in the near future. At the same time, analysts believe that a weak demand from China and concerns over excess supply will keep crude prices below $80 per barrel this year. A broader scenario is also possible. Experts do not rule out the potential for a three-way agreement between the United States, China, and OPEC+, which could lead to a further decline in oil prices. At the same time, stricter US sanctions on Russian crude oil and the ongoing geopolitical tensions could have the opposite effect, supporting oil prices and, along with them, the Russian currency. While the impact of the US sanctions on Russian oil will be noticeable, it will not be overwhelming. A far more sensitive issue is the potential effect on exports, which could in turn reduce foreign currency revenues. For now, despite inflation-related concerns, the Russian ruble has even managed to strengthen, trading below 100 rubles per dollar. Over the past 3 months, the ruble has lost only 1% against the dollar, whereas most other emerging market currencies have suffered much sharper declines. So that's all for today. We continue to follow developments in the financial market. Subscribe to our channel and follow news with us. And see you soon.